Have you ever, looked at your mortgage rate and thought, wow, just a tiny change makes such a huge difference?
Oh, absolutely. Or even just the interest on your savings account, right? It
Yeah,
creeps up or down.
exactly. And it changes how you think about saving or maybe investing. Well, today we're diving into something that quietly shapes all of that. Your whole financial world, really. From loan costs to, well, even grocery prices.
Yeah.
We're talking about the U.S. economy, monetary policy, and specifically how the Federal Reserve, runs the show. So we've got this fantastic deep dive planned. We're pulling insights from a really detailed Congressional Research Service report. Our mission, basically, is to pull out the key stuff, the most important nuggets, give you a real shortcut to understanding the Fed's role, its tools, and that tricky balancing act they're always doing.
It's kind of like peeling back the curtain, isn't it?
Totally. On this powerful institution you don't always see directly.
And what's fascinating, I think, is how the Fed often works behind the scenes. You don't see the day-to-day, but the decisions, they have these really profound, tangible effects on everyone. Your job prospects, the cost of coffee, everything.
Right.
So this deep dive, it should really light up those critical levers they pull and, why it all matters so much.
Okay, let's unpack this then. We hear the Fed all the time in the news. But for folks who want to go a bit deeper, who are they exactly? And what's their main job?
Okay, so at its heart, the Federal Reserve is the nation's central bank. Simple as that. Its main job, monetary policy.
Which sounds complicated.
It can be, but think of it like this. They manage money and credit to influence the economy, basically making borrowing cheaper or more expensive.
Ah, okay.
So to boost the economy, they usually make policy more, let's say, expansionary. They lower short-term interest rates.
To encourage spending and investment, right?
Exactly.
Yeah.
And the flip side, to cool things down, maybe fight inflation, they make policy more contractionary, they raise rates.
Makes sense.
And we saw this happen recently. Remember late 2024, the Fed cut rates 3 times.
I do remember that.
Yeah, and that wasn't really about hitting the gas pedal hard. It was more like easing off the brakes a bit, making policy less contractionary, sort of rolling back some earlier hikes they'd put in place to tackle inflation. It's a constant adjustment.
So it's this powerful hand guiding things. But who's actually making these huge decisions? Is it just one person, a committee?
It's definitely a committee. The big one is the Federal Open Market Committee, the FOMC.
FOMC, right? You hear that acronym a lot.
That's the nerve center for monetary policy. The voting members are the Fed's 7 governors.
Who are appointed by the president?
Correct. Plus the president of the New York Fed, they always get a vote because New York is, well, the financial hub. And then 4 other Reserve Bank presidents. They rotate in from the other 11 regional Fed banks.
Okay.
The Fed chair leads the FOMC. They meet pretty regularly, about every 6 weeks. And those statements they release afterwards, everyone pores over them for clues about what the Fed's thinking.
So knowing who's deciding, what are they actually trying to achieve? What are the big goals guiding all this?
Right, the goals. Well, the official mandate comes from Congress back in 1977. It tells the Fed to promote 3 things: maximum employment, stable prices, and moderate long-term interest rates.
Maximum employment and stable prices. That's the dual mandate we hear about.
That's it. Those 2 are really the core focus. And what's really interesting, maybe even surprising, is how much leeway the Fed has in interpreting those goals.
Leeway. How so?
Well, they have considerable discretion. And, crucially, there are no formal penalties if they don't meet the goals.
Wow. Okay, so a lot of independence.
Huge independence, which comes with huge responsibility, of course. And they do try to define them. Like stable prices since 2012, they've defined that as 2% inflation.
2%, using a specific measure.
Yeah, the Personal Consumption Expenditures Price Index, the PCE.
Not the CPI, the Consumer Price Index that we often see in headlines.
They look at CPI too, but the Fed tends to prefer PCE. It covers a broader range of stuff. It's generally less volatile month to month. Gives a maybe fuller picture.
And what about the other side of the mandate? Maximum employment.
That one's trickier. The Fed considers it not directly measurable. It changes over time.
Why does it change?
Things like demographics, technology, education levels. Monetary policy doesn't directly control, so it's not a fixed number. It's dynamic, a moving target.
Got it.
And it's worth mentioning, they're actually reviewing this whole framework in 2025. Some people are asking whether changes they made back in 2020, allowing inflation to run a bit hot sometimes.
To make up for past misses.
Exactly. Whether that might have played a role in the high inflation we saw after the pandemic, it's an active debate.
So hitting two moving targets, employment and prices, with lots of judgment involved, sounds incredibly tough.
Wow.
How do they try to steer things in, let's say, normal economic times? What's the main tool?
Yeah, in normal times, their go-to is the federal funds rate, the FFR.
The FFR.
Okay. This is the main lever. It's basically the interest rate banks charge each other for overnight loans of reserves. It's a private market rate.
So the Fed doesn't set it directly.
Not quite. The FOMC sets a target range for the FFR, usually pretty narrow, like a quarter of a percentage point wide, say 5.25% to 5.50%. Then they use their other tools to make sure the actual rate happening in the market stays inside that range. It steers short-term rates for the whole system.
Okay, so they set the target. What does changing that target actually do? How does it ripple out and affect, me or the wider economy?
The ripple effect. That's the key transmission mechanism. Changes in the FFR target cause shifts in interest rates pretty much everywhere else, though maybe not exactly one-to-one, and it takes time.
Right, it's not instant.
Definitely not. And it works through two main channels. First, there's what we call interest-sensitive spending.
Things people buy on credit.
Exactly. Big ticket items. Business investment, like a company buying new machines or building factory. Major consumer purchases, cars, appliances, consumer durables. And very importantly, new home construction. Residential investment.
So higher rates mean less of that spending.
Generally, yes. Higher FFR, higher borrowing costs, less spending on those credit-sensitive items. Low FFR encourages more of that spending.
Okay, that's one channel. What's the second?
The second involves international trade and the dollar's value.
How does the FFR affect the dollar?
Well, think about it. If U.S. interest rates go up, holding U.S. assets like treasury bonds becomes more attractive to foreign investors, right? Higher return.
Makes sense. Money flows in.
Precisely. Capital inflows increase. But to buy those U.S. assets, foreigners need U.S. dollars. So demand for dollars goes up, and the dollar gets stronger compared to other currencies.
So what a stronger dollar means.
It means imports become cheaper for Americans, which sounds good initially. But it also makes U.S. exports more expensive for people in other countries. So fewer exports, more imports. Net exports tend to fall.
Okay, and lower rates do the opposite.
Lower rates do the opposite. Weaker dollar, more exports, fewer imports. Net exports tend to rise.
Yeah.
So Fed decisions have these global ripple effects too.
And all these effects on spending, investment, housing, trade, they directly impact our overall economic health, like GDP.
Absolutely. Business investment, consumer durables, housing, net exports. These are all major chunks of gross domestic product, GDP.
Right.
So expansionary policy, lower rates, aims to boost GDP and jobs in the short run.
But the trade-off is inflation.
That's the risk. It can put upward pressure on prices. Contractionary policy, higher rates, does the opposite. It slows GDP and job growth to try and curb inflation. The Fed is constantly trying to balance these trade-offs to hit that dual mandate.
It's a fine line.
A very fine line. And there's an important point here. Most economists think monetary policy can permanently change inflation, but they generally believe it cannot permanently change the long-run level of GDP or its growth rate. That depends more on things like technology, workforce skills, etc.
So the Fed manages the cycles, not the long-term trend.
That's a good way to put it. They try to smooth out the bumps, and they try to look ahead because policy changes take time to work, these lags. They also try not to surprise markets too much. They communicate a lot.
But they also say they're data dependent.
Right, which means plans can change if the economy doesn't evolve as expected, but being purely reactive can make things volatile. So they try to signal their intentions, avoid sharp U-turns if possible. It's that balance, again, being predictable but also responsive.
Okay, so that covers the standard playbook. But what about major crises, like the 2008 financial crisis or the pandemic, when the usual tools just aren't enough? That's when things got really interesting, right? The unconventional stuff.
Exactly. That's when the economy hits the zero lower bound.
Meaning interest rates are basically at zero.
Pretty much. Twice in its history during that 2007-2009 crisis, and again with COVID, the Fed pushed the FFR target range down to 0%, 0.25%. At that point, you can't really cut short-term rates any further to stimulate things. So conventional policy was maxed out.
So they had to invent new tools.
They had to turn to what we now call unconventional monetary policy tools. The main goal was to push down longer-term interest rates, not just overnight ones, to provide more support. And yeah, this was groundbreaking stuff. It really redefined what central banks could do, and it sparked a lot of debate.
Okay, so what did these unconventional tools actually look like? What were they doing?
Well, the most famous one is probably quantitative easing, or QE,
QE, right? Buying bonds.
buying massive amounts of bonds, trillions of dollars worth of U.S. Treasury securities and mortgage-backed securities. The direct goal was to lower the yields on those securities, which then hopefully lowers other long-term rates, like for mortgages or corporate borrowing. The scale was just unprecedented.
Wow. Okay, what else?
Then there was forward guidance. This was more about communication.
Not buying things, but saying things.
Exactly. The Fed basically promised to keep the FFR near zero for a long time. The idea was to shape expectations. If investors believe short rates will stay low way into the future, that should help bring down long-term rates now.
Influencing market psychology.
Very much so. They also used large-scale repos, repurchase agreements, essentially short-term loans, to pump more liquidity directly into the financial system, keep credit flowing.
And didn't they set up special lending programs too?
Yes. Using their lender of last resort powers, they created temporary emergency facilities to backstop specific crucial parts of the financial system that were freezing up. This was vital to prevent complete collapse in both crises.
And all this activity,
Yeah.
buying trillions in assets, it must have massively inflated the Fed's balance sheet, right?
Oh, absolutely. Hugely. Just like a company's balance sheet, the Fed lists assets and liabilities. The asset side swelled with all those treasuries and mortgage-backed securities from QE. The liabilities side grew mainly through the increase in bank reserves held at the Fed. Because when the Fed buys an asset, it pays for it by crediting a bank's reserve account.
So this size tells a story.
It really does. It went from under $1 trillion before 2008 to over $4.5 trillion after that first wave of QE. Then during the pandemic, it shot up again from around $4 trillion to nearly $9 trillion by early 2022.
9 trillion, that's enormous.
It is, though it's important to add it has been shrinking gradually since mid-2022. They're letting some assets mature without reinvesting. That's called quantitative tightening, or QT.
So these crises didn't just bring temporary tools. You mentioned the Fed's whole approach changed. How does it operate differently now, day to day?
Yeah, the shift is fundamental. It's a completely different operating system compared to before 2008.
How so? What was the old way?
Okay, pre-crisis, remember, the Fed couldn't pay interest on bank reserves. That's key. So the New York Fed would conduct daily open market operations, small purchases or sales of treasury bills, often using repos just enough to nudge the supply of reserves up or down slightly. Because back then, reserves were scarce. Banks held just about what they needed, maybe a tiny bit more. So small adjustments had a direct impact on the FFR.
Okay, scarce reserves, daily tweaks. What's the new way?
Post-crisis, everything changed. They got the authority to pay interest on reserves. So now they mainly steer the FFR by setting the interest on reserves IOR rate directly. That's the rate they pay banks for parking money at the Fed. They also use an overnight reverse repo facility on RRP, which lets certain institutions lend money to the Fed overnight, effectively setting a floor under rates.
So they set rates directly now instead of adjusting reserve supply.
Pretty much. The IOR acts like a magnet for the FFR, and the reverse repo rate acts like a floor. These directly anchor the FFR within its target range.
Why did they switch? Why this new system with abundant reserves?
It's largely because of those abundant reserves. Remember QE? It flooded the system with trillions in reserves.
Right. Banks are holding way more cash at the Fed now.
Exactly. Even though the Fed actually eliminated reserve requirements in 2020, banks hold these reserves anyway. With so much liquidity sloshing around, the old method of adding or removing small amounts just wouldn't work anymore. It wouldn't move the FFR effectively.
Like trying to adjust the water level in a full bathtub by adding a cup?
Perfect analogy. But the IOR gives them a powerful tool. By setting the rate they pay on reserves, they influence banks' decisions about lending that money out versus just keeping it at the Fed. It helps control rates even when reserves are super abundant. They also added a standing repo facility in 2021 to act as a ceiling, letting banks borrow from the Fed if needed, so they have this corridor system now.
Okay, this connects to inflation. The old saying is, too much money chasing too few goods. If there's so much money, these trillions in reserves, why haven't we always had runaway inflation since 2008? Does money supply still predict inflation?
That's a really central question. And yeah, the link isn't as clear-cut as it maybe once was. Historically, yes, strong money supply growth often did correlate with higher inflation. And during the pandemic, we did see historically high growth in the money supply, especially the monetary-based currency, plus bank reserves. QE was a big driver of that, and we saw high inflation follow.
So the link was there recently.
It seemed to reappear then, yes. But outside of that specific period, over the last few decades, the relationship between broad money supply growth and inflation has been, well, less reliable.
And the new system plays a role, this IOR.
That's the argument. The ability to pay interest on reserves gives the Fed a way to essentially sterilize those reserves. By paying banks to keep the money parked at the Fed, it potentially stops those reserves from multiplying through the banking system via lending, which would otherwise fuel spending and potentially inflation.
So they could have a huge balance sheet, abundant reserves, but maybe keep inflation in check using IOR.
That's the idea. It allows them to separate the quantity of reserves from the stance of monetary policy to some extent. It's a key innovation, but also still debated.
Okay, last area. The Fed has all this power, this independence. Does Congress just let them run free? Is there any oversight?
Oh, there's definitely oversight. Independence is crucial, yes, for making tough long-term decisions without political interference.
It's not absolute.
Not at all. Congress delegated the power, but it kept oversight responsibilities. By law, the Fed has to report to Congress twice a year. They submit detailed written reports, and the Fed chair has to testify before both the House Financial Services Committee and the Senate Banking Committee.
And those hearings can get pretty intense, right?
They certainly can. It's a public forum for lawmakers to question the Fed's actions and hold them accountable. It's that balance independence in operations, but accountability to Congress and the public.
So, wrapping this up, what's the big takeaway for you listening to this? We've covered the Fed's role, its goals that dual mandate, its main tools like the FFR, the extraordinary steps during crises like QE and forward guidance, and how the whole operating system has changed.
I think the main thing is just how dynamic and adaptive economic policy has to be. The Fed isn't working off some ancient, unchanging script. They're constantly learning, tweaking the framework, facing new, often unexpected challenges in this really complex global economy.
Yeah.
It's always this balancing act, right? Growth versus inflation, using imperfect data, knowing their actions take time to work. It's incredibly complex.
Which leads to a final thought for you to chew on. Given everything we've talked about, the dual mandate, the data dependence versus avoiding surprises, the global factors, what do you think is the single biggest challenge the Fed faces right now in trying to achieve its goals? Is it predicting inflation accurately? Handling shocks from overseas? Maybe navigating political pressures? Something else entirely. Lots to think about there. We really hope this deep dive gave you a useful, informed shortcut to understanding this crucial part of our financial lives.
Yeah, hopefully demystified some of it.